Hello and welcome to a quick webinar discussing the differences between deciding on a lump sum payment or a annuity monthly payment for your company pension plan. My name is Justin Rucci and I'm a certified financial planner for Warren Street Wealth Advisors. Before we get started, just a quick word from our disclosures and compliance department. If you would like a copy of our Form ADV, it is available upon request by calling our main phone number 714-876-6200. To help make this decision of lump sum versus annuity, I'm going to go over the pros and cons in each. I'm going to go over some specifics to the current market conditions that may factor into your decision, as well as some of the personality factors that you want to make sure that you are applying to your decision as well. So to start, I'm going to go over the pros and cons of the lump sum. The main pros are that you have tremendous flexibility in the funds. So you get the money up front. You have full discretion as to how quickly or slowly you spend that money. So you have full access to the funds right away. You also have the ability to defer the taxes on the income, meaning if you take this lump sum and you don't need a payment from it for a year or two, you do not pay any tax until you actually take money out of the account. And then even then, you only pay tax on the amount that you do take out. Number three here, you have the ability to reinvest it in the market, meaning you can grow this money so you can afford to give yourself cost of living adjustments over time. And if you're in the scenario where maybe you don't need all the money up front, which most people don't, you can let the majority or all of the money be invested and hopefully grow so that when you do need it, you have more available to you. Legacy and inheritance planning is huge. The lump sum is flexible. It's like any other asset you have, like a bank account or 401k, where you can leave it to your spouse, you can leave it to your kids, you can leave it to a charity. It's literally endless in terms of possibilities on how you plan for your legacy and inheritance because it's your asset, it's your money up front, so you can do whatever you please with it. And lastly, the main pro is that it improves your liquid net worth. So it's an asset on your balance sheet right away. So when you look at what you have available to you in retirement and what your overall net worth is, you now have a large dollar amount that you just added to your balance sheet as part of electing this lump sum. So to summarize, the main advantages of the lump sum are that you have flexibility and total control, whether it's how quickly or slowly you spend it, how much or little of it is taxed each year, and how you invest it, as well as how you leave that money to your heirs. So you have total control, total flexibility, and that's the main advantage of the lump sum and the primary driver of why many people choose it. There are, of course, some disadvantages to the lump sum. The biggest one that we see is that it can create poor spending habits in some cases. It's rare, but it does happen where somebody sees all of a sudden this six-figure dollar amount that they're getting and they go, well, I have that available to spend, and they spend it really early on in their retirement, not leaving it for the remainder of their retirement. So if you think that you might be too tempted by a large dollar amount and seeing that in your account and it's going to create poor spending habits, sometimes that can be a disadvantage to the lump sum. Being subject to market and investment risk, I'll cover this a little bit more in a couple slides, but yes, if you take the lump sum, it's subject to whatever investment risk you set it up for. Obviously, you have us to help you manage that risk, and we can make sure that you're not being too aggressive or risky with it. And if you want to be conservative or moderate, whatever it may be, we obviously set that up for you. But nevertheless, it is still subject to market and investment risk. The last one here, if your lump sum payment is not properly handled, it could trigger a taxable event. This would never happen for anyone that we work with, but for cases where maybe somebody doesn't have a financial advisor, does not realize that this lump sum needs to be rolled into an IRA to avoid taxes, they may just take it all at once, put it into a bank account, and then get hit with a huge tax bill. So now let's move to the annuities, or the annuity or the monthly payment and the pros of this. The main advantage is that you get a guaranteed income for life, meaning if you live to 100 years old, this annuity will pay you until you are 100 years old. Of course, the inverse of that is also true, which I'll cover in the cons section. Second advantage here is you do have income options available for a spouse. So if you wanted to have a payment tied for your life as well as your spouse's life, you can do that. It lowers your payment. So if you're set to receive $2,000 a month and you want your spouse to be covered as well, you're going to receive less than $2,000 a month to pay for that as essential insurance to cover your spouse's benefits as well, but it is an option. Third one here is no market fluctuations. So whatever you are quoted to receive per month, you will receive that amount each month for as long as you live and as long as your spouse lives if you predecease them and you have that benefit. So the payment stays the same. Also can be a con, which I'll cover in a minute. Lastly here, you have the opportunity to receive more benefits if you live long enough. So I covered this a little bit already, but if you live to 100 or 110 years old, you will get paid that entire time. The cons are that you may not live long enough to get that full benefit. So this is unfortunately the more common scenario. Is there's a lot more people dying before the average life expectancy than there are living to 100 or 110. So there's always the risk that you pass away early, or maybe you and your spouse pass away at the same time earlier in your retirement, and basically all that money is left on the table and stays at your employer. You have no control over the timing of the cash flow and payments. This is a big one too, is you get that set monthly payment for life, but you cannot control how quickly or slowly you get it. So you literally have to wait each month to get that money. You don't have access to those funds up front to be able to spend it at your pace. Number 3 is you have the same fixed payment for life. Very rare do pensions have cost of living adjustments or increases each year. For the main employers we work with, they do not. So most employers do not have a cost of living adjustment, meaning whatever you're quoted today might buy you a certain amount, but 10 or 20 or 30 years down the line into your retirement, you probably won't be able to buy very much with that payment. You have no ability to leave money to your heirs besides potentially a spouse. So covered this a little bit already, but you have no ability to leave money to kids or charity or anyone else. You can literally only name a spouse on this. And if something happened to both of you at the same time, well, then that's it. And the company keeps the rest of that benefit. Income contingent on the longevity of the employer. So I'll cover this a little bit more in a couple slides, but essentially this is an IOU from your employer, meaning you're on the employer's payroll for another 20 or 30 years of retirement. So as long as the employer can afford to pay you, they're obligated to. But if that employer goes bankrupt in that time period, which is always possible, we never know. Nobody thought Sears would go bankrupt or JCPenney would go bankrupt. Then you're potentially going to lose a portion of your pension benefit. So your income is contingent on the employer's ability to be able to pay it, which I think a lot of people tend to forget. So that's an important one. So how do the current market conditions impact this decision? Interest rates being as low as they are in pretty much all-time lows increases lump sum values. So that's another advantage to lump sums right now. Number 2 is the ability to deploy a large amount of capital into the market right now is another huge, huge advantage of the lump sum right now. Everybody sees the markets come down in 2020 because of coronavirus, gets scared, and actually the inclination is to go towards the annuity. That's the opposite of what you really want to do. To have a big lump sum payment come your way and to be able to invest it while the market's down is a huge advantage, because historically every time the market's gone down, it's recovered for people who were patient long enough. So if you could invest a large lump sum of money at depressed market values right now, you have the potential to grow it pretty substantially when the market eventually hopefully recovers. So that's a huge advantage, and it's important to not be scared about investing the lump sum right now. And lastly, tying your income stream to the longevity of any one company comes with a lot of risk. Like I mentioned, it's an IOU from them. So you don't want to have your retirement dependent on the condition of one particular company's financials, especially for oil and gas retirees who are frankly in an industry that is not looking good long term. People continue to use less and less and move more towards clean energy. So I'm not sure that's an industry I want to be relying on for the next 20 or 30 years. Personally, I take my money up front if I'm in that industry. Lastly here, your personality, how does this fit in? This includes your spending habits. So whether or not you feel comfortable taking the lump sum and being able to manage it properly with our help, of course, we would make sure that you don't spend it too quickly, or at least try to make sure that you're educated on that. Beneficiary desires: do you have children or charitable inclinations that you want to make sure that this money ends up with, in the event that you don't end up needing it all? Do you have beneficiary desires that you want to make sure the money gets allocated to? Other income streams. So do you have Social Security most likely as a fixed income stream? What other assets or income streams do you have to try and balance out? Do you need more liquid assets? Do you need another fixed income stream besides Social Security to feel comfortable? What do your other income streams look like? What's the sentiment on your employer? Do you feel confident that they're going to be able to pay you this IOU for such a long time period? And life expectancy: what's your family history? What's your health? Are you expecting to potentially outlive your money? Is your life expectancy average or below average? Those would favor the lump sum. And lastly here, investment risk tolerance. So this is something obviously we'd help with, but are you conservative, moderate, aggressive? What's your comfortability with investing money in the market? Last slide here is, if you have questions, be sure to reach out to us. Again, my name is Justin Rucci. My phone number is on the screen there. My email is just justin@warrenstreetwealth.com. If you work with Emily, you have questions for Emily, her contact information is on the screen as well. Be sure to reach out with any questions you have. This is a case-by-case situation, so we're happy to talk through any specifics to your specific case. Thank you for watching.